Welcome to the Capital Gains Tax Solutions podcast, your shot of clarity to break out of capital gains tax jail when selling a highly appreciated asset such as real estate or a business. I'm your host, Brett Swarts, and the Capital Gains Tax Solutions podcast is a multiple episode per week show. On Mondays, we have interviews from notable people from the world of real estate investing, real estate brokerage, and financial planning space, talking about what's new in the tax deferral space, investing in real estate for cash flow and passive income investing. And from time to time on the show, we also have special guests where we are diving deep into the Deferred Sales Trust, and that is this show for today. We have Michael McIntyre, who is the national trainer for the Deferred Sales Trust and for the estate planning team. And as a quick note, I'm also a member of the estate planning team, and Capital Gains Tax Solutions is one of the exclusive trustees for the Deferred Sales Trust. Hey, if you have questions, you can send them in to Brett@capitalgainstaxsolutions.com. That's Brett@capitalgainstaxsolutions.com. And then Michael and I will do our best to answer them live on the air as it pertains to the Deferred Sales Trust. Hey, this series and this podcast, this is not for rookies. Our audience is made up of seasoned business professionals and high net worth clients who are investors, developers, multifamily syndicators, investment bankers, commercial lenders, and commercial brokers. This show is available on more than 20 different platforms, and wherever you listen to podcasts, you are sure to find the Capital Gains Tax Solutions podcast. We love to have you as a listener make Capital Gains Tax Solutions podcast a part of your weekly routine. Have an awesome rest of your day. Go serve and bless others, and let's dive right into the show. Hey, Michael, how you doing?
I'm doing great.
Excellent. Well, glad to have you back. And this is part of our series on making the Deferred Sales Trust simple, or Deferred Sales Trust made simple. And so we're going to dive right into our subject for today, which is, the main subject of competitors, right? So, why use the Deferred Sales Trust versus the 1031 has kind of been a lot of the content that we've created so far, but we haven't necessarily dived into some of the I guess closer competitors or other alternatives that maybe aren't as known. And so although we will touch on the 1031 at the end of this as a reminder, I want to actually dive into one of the most commonly commonly asked ones that come up, and the answer to that is the monetized installment sale. So Michael, give us your take on the monetized installment sale, and then what is it, and how does it compare and contrast versus the Deferred Sales Trust?
Well, first off, I'm probably a little biased person to be talking about because I'm the national sales trainer with another company, and I'm probably not qualified to completely look at the structure. But the basics of the structure would have me troubled if I was a consumer. And the consumer aspect is that the structure, basically, as I understand it, you're getting an installment sale, you're doing that. And then ultimately what you're doing is you're getting a third-party lender to lend you the money on the asset itself. And as far as I know, when I've read IRC 453, that only works if you're an agricultural business. So I'm not sure. I see lots of applications on it, and I've read a couple different reports in the industry saying that it was under a great scrutiny. So I'm not sure I would feel comfortable in going against what the IRS would actually do, what they're actually saying on the structure. So I think it goes beyond the limit. And then there's another concern besides that. Ultimately, I'm not aware that they represent their product in the event of an audit. One of the things that we've done for years is offered a audit defense. And so based on those couple things, I think the consumer should be very concerned about that particular structure. Installment sales certainly work. They've worked for 90 years. I'm not saying that at all. I'm saying that if you go out and borrow money against the promissory note and the IRS finds out about that, I'm not sure that works anymore. I think it's sort of like polluting the water at that point for the IRS. Now, maybe the IRS will never catch up on it. I have no idea. But why isn't the supplier of the service providing some sort of indemnification if they really believe in it? So those are the two kind of prima facie things that I would look at if I was a consumer from that standpoint.
Got it. Yeah. So on the monetized installment sale, some of the questions that you would ask, or if a consumer were looking at the deferred sales trust versus the monetized installment sale, might be, are you under IRS review? And if so, what's the current status of that particular case or review or audit? And also, too, I think one thing that comes to mind is for me would be what reviews have happened in the past, and were they for your actual clients, and what was the outcome of those? Right. Plus, how long have you been doing it for, and how many cases have closed? And so, have you had any kind of clarity on that, Michael, as far as the track record for the monetized, and then let's compare that against the deferred sales trust for our listeners, so they understand that as well.
Yeah, I think those are great points. I have no idea what they've performed. I've never done a due diligence, a personal one. I'm not capable of doing a due diligence, but based on the basic kind of sniff test of things is, would you buy a car without a warranty? Would you ever do that? No matter what the brand would be. Would you buy a car that maybe, that the instruction manual and everything else don't match with ultimately what the design was itself? So I'm just from that two standpoints, I just ask, do your own due diligence.
Yeah, well said. And then on the deferred sales trust side of things, walk us through the car analogy with the warranty and the track record and the some of the what it's done. How it's survived the scrutiny from the IRS, and how Campbell Law Firm has done has been able to represent their clients and provide that audit defense. Would you walk us through how it compares to on that point?
Sure. The structure itself is 25 years old. The marketing is about 22 years old. So for a few years, our structure was nameless. It was a nameless baby, if you will, nameless car, whatever you want to call it. But we've done several thousand trusts now, and I'm not aware that we're at this point under any audit, or any of our clients have been under audit, or that we're under any scrutiny at this point. And I was last updated on that probably in July. I don't think really the IRS has bandwidth right now to really do deep audit, to start a deep audit. This year has been, with the pandemic and handing out checks instead of doing anything else. I think the IRS has their hands full. But the other thing is that after doing thousands of these audits, I was only aware that about a dozen clients that we had were ever audited, which we were not the trigger for the audit. We were not the reason for the audit, and there was no change to the audit. We ourselves, I'm aware that we were audited twice, and the most recent one was completed in about this time, maybe a little earlier, in 2019. So we're not under any scrutiny. We have followed strictly what the rules are from the IRS and complied with that. And I think that's an important distinction, is that we've got a 25-year track record of the structure itself, a quarter of a century, if you will, of a clean 100% survival rate. Now we have the scar tissue to prove it, because we've been through a lot of different things, and that, I think, doing thousands of these structures gives you a little bit more gravitas, that we're actually have been around. We've been through that. We've had, I think, really frank discussions with the IRS. And that's an important thing, is that you're following those rules. And we have a brilliant attorney, Todd Campbell, and Todd Campbell, both a great thinker and a great bedside manner for every client that I've ever experienced with.
Yeah, he is. He's fantastic, and so is Jake Pfeiffer, and of course Robert Binkley, who's the co-founder of the Deferred Sales Trust and financial advisor. Right. So we're all a team working together, and then also with the banks and national law firms that we have connected with us as well throughout the country. That being said, so if I'm hearing you right, you're saying, hey, look. I would, if I'm in your shoes, ask them how many deals have closed, how many IRS audits they've been through. Of those, how many were their actual clients, and what was the outcome of those? Are they currently under, any kind of investigation, right, or court case, and compare that to the Deferred Sales Trust, where it's been thousands of closes over 25 years, no current pending cases as of when we're talking today. And the last one was in 2019. I think that was a formal audit. And these are all no change audits, not one single issue with over a dozen of these audits. There are also no trigger audits. So not only was it on actual deals, but also was on the actual structure in Robert and Todd and the whole thing there. So that is that gives me peace of mind. I know personally, and for my clients, in being a Deferred Sales Trust trustee, it gives me peace of mind knowing that Campbell Law stands behind their work and provides the audit defense, and has actually had clients go through the audits and come on the other side.
I just wanted to say one interesting thing about that audit: 12 audits out of thousands that were non-trigger. I wondered for a long time why that was. That seemed like a magnitude lower than the average person gets audited. And I wondered why that was. But if you think through it real carefully, let's say you sell your business, and you sell your business for 5 million. And normally you're used to making, let's say, a couple 100,000 a year. So you go from 200,000 to 5 million in a year when you declare it. I submit to you that you would be under a higher risk of audit by not doing the Deferred Sales Trust than doing it. And clearly, the numbers kind of pan that out. Maybe a magnitude or two lower than the average audit.
That makes sense. So yeah, what you're saying is, hey, if you're selling like a $5 million business and you had a zero basis and you had to pay, let's say, $2 million in tax,
sure.
And instead of doing no tax deferral strategy, you just take all $5 million in that given year, you're probably, you went from making $2 to $250 a year to all of a sudden $5 million, right? You're probably
right.
a higher chance of getting audit versus just doing an installment sale, a deferred sales trust, and then just taking payments slowly over time. That being said, in the very beginning, you mentioned, borrowing against the promissory note. Would you clarify for our listeners, Michael, how on a deferred sales trust, third-party unrelated trustee, by the way, that's our role here with the Deferred Sales Trust. We're not a bank, we're not a lender, right? But you are becoming the lender, and you are the trust is paying you back the amount that's owed to you plus interest. Would you clarify that for listeners versus the monetized? Because I think that's a key distinction here. Because my understanding is 93.5% of the money is basically at the close of the monetized installment sale is sent to the seller, and they receive all of that cash, and they say, hey, you can do whatever you want with it, which sounds pretty sweet, right? You just pay a little bit, you pay those fees to us up front, but you get 93.5% right now, and there's no other restrictions. So would you clarify the differences with constructive receipt with the Deferred Sales Trust versus that?
Yeah, as I understand it, I'm not sure what the percentage is, but if it's 93%, like you said, I take you with that. I'm not sure how they do their structure, but in our case, we just have the trustee grant the trust. And like you said, he's a third-party independent. That's really critical. I'm not sure what they do with other structures, how independent it is. There's cases, I think there was a case which was Michael's, the craft store years ago, and they had an employee who was actually the trustee. And the IRS has actually ruled that an employee is not an independent person, which does make sense. So you're not, or any of our trustees are not employees of ours, number one. They are not related, or they're not employees of the client. And that's important feature. And so you're, as the trustee is the grantor of the trust, of an irrevocable trust. Then the next thing is that they buy the asset to owe the asset, right? So the trustee owns that asset and then owes them 100% of it. They do not assist in any way to get a loan against that asset. I think that maybe there's a non-related party if there's involvement of hypothecating than promissory note. That doesn't sound, that again, that doesn't sniff right for me. Maybe somebody smarter can explain it to me slower on that, but I just don't see how that works, how negotiating the loan and doing all that doesn't cross into related party issues. Because if you're actually employing somebody to borrow money for you or do that sort of thing, that doesn't sniff right either. So the more you peel this onion on this thing, the more that it would trouble me. And again, do your due diligence properly.
Yep, that makes perfect sense. That well said. So let's shift a little bit into traditional installment sales, right, Michael? So the next competitor would be, well, why do I need a third party unrelated trustee in the deferred sales trust and pay these fees for this installment sale? If I can just do an installment sale by myself, why not just carry paper for the buyer and I'll just do my own installment sale? What would your thought would be for that if you're in that position, Michael?
Yeah, billions of dollars every year are done on third party or on, between the seller and the buyer. And they're usually done on businesses and on raw land. Not because they really want to, it's because they have to. It's a basic form of finance that has existed for over 90 years. And if you're selling a property, would you rather take cash or would you rather carry a note on it? Now, a lot of people really do prefer to carry a note, and that's perfectly great. However, the problem isn't when you do the transaction, it's when you try to recover the transaction itself. And that recovery can be a terrible life stressing event to recover an asset. Say the asset goes down, you sell a business and the guy, why isn't he paying you? Well, he's not paying you because maybe he's run it into the ground, run that business in the ground, and there's no revenue to pay you. How do you recover an asset on a business? How do you foreclose in the midst of a pandemic? How do you do that? How do you, what's next? We had murder hornets this year. We had pandemic. We had all these things. What's next? And how long will it take for you to recover your asset? In certain states, you and I are in California, pretty hard to foreclose, pretty hard to evict. Think about all those things on recovery. It's not the beginning, it's the recovery of that asset. Are you going to get your money back? Now, with the Deferred Sales Trust, it's a non-recourse loan. So under non-recourse law, you are able to recover your asset. Nobody's going to personally guarantee your investment, right? Nobody's going to personally guarantee your investment, but you're going to select your collateral, how you need it, what your needs are, what your goals are, which could even include taxes. So taxes could be a really big consideration. And maybe what you want to do is you want to tax engineer that money to come back. Maybe you have an income cash flow need. Maybe you need that to accelerate. You can't really carve out that recourse of what your collateral is in a traditional installment sale. It's very illiquid. It's very hard to recover. With the flexibility of foreclosure on the asset, if I'm a note holder and I wish to foreclose, I can have it in my note that I could foreclose. Now it's based on the collateral or the investment that I selected. So that's on me. It's not on, there's enough problems in life of having somebody else ruin your life than you doing it yourself. So you're in complete control with the Deferred Sales Trust. You have the collateral, you have the terms, you have the taxes. That's what you need.
Absolutely. Really well said. And also to that point, the timing aspect too, right? You're typically the traditional installment sales, they're 3 to 5 years, maybe 10 years if you're lucky. But then they're also typically self-amortizing. They're not typically a big balloon payment, but even if they were, you're still pretty limited to maybe 3 to 5 years of deferral. And so most of our clients like to have not only 10 years of deferral, but renew it for another 10 years, renew it for another 10 years, pass it to their kids inside of our living trust, and essentially keep this deferral going on for a very long time versus just a short deferral. Which also leads into the second thing, which you kind of mentioned, which is diversification, right? If you're selling to someone on terms, right, and you're carrying back for them, they may have not been able to obtain a loan. That's maybe why you're doing it. Two, they're not investment grade, right? They're typically, you can invest the funds and have collateral in stocks, bonds, mutual funds, some of the biggest companies in the world, some of the best money managers in the world. SEI is one of them, right? Which is one of our inner kind of circle, if you will, for investment groups you can invest with. And they manage the MLB pension. They manage the Mercedes-Benz pension. And so you say, would I rather have my money against my old property or business? That's, by the way, I might have to take back. If they don't pay, I'll have to foreclose, and maybe I sold that to be done with that to begin with. And what a stress that might be. If you're a veterinarian or a dentist or optometrist, you sold your business, you think it's going great for the deferral, and you're in your retirement 5 years later, and all of a sudden the payments stop. And now you have to foreclose, and now you have to take that business back, and that business that you sold for $5 million maybe only worth $4 million, right? Or $3 million. That's why he couldn't make the payments, because he wasn't running it properly, or she wasn't running it properly. So you have to take that back and now come out of retirement. Most of our clients want to be done with the toilets, the trash, the liability, and they want their collateral secured against some of the biggest companies in the world, right? And or back into real estate, small amounts, right, at their own timing. So I think that's also important to recognize, is the importance of diversification in this COVID-19 world, as well as, a recent deal we just closed was for a client of mine. He sold his business out of Alabama, and he's actually he's in his 40s. And he wanted to shift careers. So he went from basically like marketing business, and he wanted to go into the commercial real estate development business. And his partners weren't ready to sell their business, but he said, hey, I really want to get out. And so they said, okay, we'll buy your business. Okay, we'll buy your percentage of the business. And so they did that. And it was about a $2.5 million sale, and we deferred about $600,000 of tax. But what was neat for him was not only that he deferred the tax, but then he was able to use some of the funds to go back and develop real estate. He's developing 80 units in Tennessee. And so it was transformational for him, because it wasn't only just tax deferral, but it led to the funding, you will, of his next business venture, his second part of his career, which was real estate development. And also in the meantime, it can go into stocks, bonds, mutual funds, and have some liquidity. So I just want to connect those two, where if you're doing a traditional installment sale, you're beholden to that one person and that one deal, and you're not liquid, you're not diversified, and you're not going to be able to use those funds to be able to go buy new deals. So any thoughts on that part of it, Michael?
Yeah, the whole idea of going from tenants, toilets, and trash to cruises, clubs, and cocktails assumes that you want to retire. And the first thing that we talked about was, would you advise yourself to take a note, a promissory note? Let's say you had a third-party person, okay, your favorite person, maybe not your brother-in-law, okay, but maybe your favorite person, whoever that might be. And would you advise them to take 80-90% of their net worth, or really high percentage, and bet on one guy, which is for him or a company to pay you back? So if you look at it in those stark terms, maybe that's not such a great idea itself, versus what you were saying is looking at that. So there's
Pause there real quick. Make sure the listeners understand that, hey, the Deferred Sales Trust, isn't Brett one guy? Isn't he one trustee, right? Or one company? Walk them through that distinction and what you just said to make sure we get crystal clarity there.
Yeah, though Brett is one guy who's a trustee, but he's also controlled by many other guys. So that what you're talking about is maybe theft. So concern that maybe Brett could move things. Whenever you read something about a fraud that occurs, it's a lack of transparency, number one. Number two, the client lost governance on the account and somebody else was making these decisions for them, unbeknownst to them. And it was probably a scam from the beginning, or maybe it started off with good intentions and then, it deteriorated and then there was a fabrication behind it. With the Deferred Sales Trust, you have full transparency of your investments at all times, 24/7, and you have a governance, which is the transference of those. So
And then also
in
the
terms of your
investments
power,
itself.
in terms of your power, as great as you are, it's pretty feckless when you've got these other things that are going on. So
Exactly right. Exactly right. And just so the listeners who are listening for the first time, the funds don't move without your signature, and the
right.
investments aren't made without your approval.
Mm-hmm.
And so we have a large bank who provides kind of like an ongoing escrow, which we're going to be covering in a future episode on DACA, which stands for Direct Access Control Agreement or Deposit Account Control Agreement, which essentially is like, think of it like a long-term 1031 company or a long-term escrow. It's sitting there, and then it only is going to move when you sign for it to go into investments or to pay you or to pay any fees associated with the trust. But that being said, less so about theft. Even if I woke up and I was a bad guy and wanted to move the money, I can't do that. More so about just the actual investments themselves, right? Because what you're counting on as a deferred sales trust note holder is, where is my collateral invested, right? And that, I think, was the key. Is it invested in a single asset with a single person who I'm trying to put all my faith in? Like you said, 90% of my wealth is tied to, even if it's my person that I really trust and like, I'm betting on that one person. Or is my collateral with SEI? Is it with Swan? Is it with, invested in Netflix, Apple, Google, bonds, mutual funds, ETFs, insurance products, real estate, REITs, right? And essentially that's what you're betting on. You're betting on some of the best companies in the world. That's where your collateral is versus one single person. So does that make sense, Michael? You want to connect those two?
Yeah, I think, back to the basics is that you've got terms. You get to tell what your terms are because you're the lender. Then there's taxes, and then there's collateral. So all three you're able to carve out for yourself and for your family to the terms that are suitable for you. And that collateral is going to be based on your risk and tolerance. And then we have a questionnaire that we go through with each client so that we know them. One of the rules that all securities advisors learn is this rule by the New York Stock Exchange, which is know your client, Rule 405A. And so know that client, know them well. One of the things that good financial advisors do is kind of stop stupid from happening, right? As we say in the financial services business. And what's great about this is that there are other parties that are acting as fiduciaries here to direct and to advise the client properly so that they do have access to the best quality investments that they can select. And that's what I would want. I would want that collateral for myself and for my family, because let's face it, retirement's really expensive. Everything's going up in price. Think of something that you bought. If your life expectancy, you're 65, you're going to live another 30, 35 years. What did a car cost 35 years ago? Go look it up. Go look at all the things that are expensive. And guess what? Life changes. So the taxes and the terms of that note are going to be really critical to you in changing that collateral too, because you can change the collateral too. If that collateral is not performing, you have every right, because this is your money. I can't emphasize that enough, is that money, that collateral is your money. You need to see it. You need to change the taxes. You need to change the terms. What if in the future taxes change? We're up for an election right now. What if things completely change? Could you change the terms of your collateral? Could you change the terms of your investment? You need to be the ability. And the great thing about America that I really love is that you can make changes. You can change your course, you can change your direction, but you can also fire somebody too. That's going to be important, that you are able to have the power to make changes there with your collateral. So taxes, terms, and collateral, very big.
Love it. Well said. And just to clarify too, we work with some of the best financial advisors across the U.S. And my main business partner is Robert Binkley, but I'm not an employee of his. He's the financial advisor who provides that service, and then Capital Gains Tax Solutions is the trustee. So we kind of have the balance of powers, and we have the tax attorneys who are not the trustee and not the financial advisor either. And so we're all working together as a team to perfect this strategy, and that helps to bring transparency and lots of eyes and ears on the structure itself. And that's why thousands have closes now, 25 years, and we're still coming. We're still going, we're still growing. And with that being said, let's shift into the next one, Michael. And this is an often confused competitor. It's called the Delaware Statutory Trust. It's known as maybe the original DST, although we would argue we're the original DST. We kind of both came about similar time periods and also kind of similar prominence, but most people get the Deferred Sales Trust confused with the Delaware Statutory Trust. Walk us through what the Delaware Statutory Trust is and is not, and compare that against the Deferred Sales Trust.
So the Delaware Statutory Trust is an entity formed in Delaware under the rules of Delaware. Well, Delaware has very favorable tax rules. That's why a lot of corporations have chosen to incorporate in Delaware. And as such, it follows the 1031 rules, which is basically, think of it, normally when you do a 1031, you have 45 days to identify and then 180 days to close. And normally what most people think of the 1031 is they do it themselves. But what if you're tired, you're kind of in that halfway point, you love real estate, but you don't want to you don't want to manage it yourself. So a syndicated deal, that's where you have a big company that will purchase real estate that is a professional company on real estate, and they will carve up, if you will, slices of real estate, and then you can identify that with what's called a qualified intermediary, the QI, and they will identify perhaps that the syndication that you want to do, and then within 180 days, if you close that, you defer all the taxes. And the beautiful thing about real estate is that for the most part, it provides great tax benefits for you, appreciation, income, some great some great opportunities there. Now, unfortunately, syndicated deals have not worked out as well as regular real estate. They have a measure of much lower returns because there are more expenses in these deals. You need to be very careful about that. You're losing control of that real estate, and you have to. Many people want to lose control. They don't want to do that, but at the same time, they want to be able to fire them, like we talked about earlier. And so that becomes a difficult measure. Is that it becomes like that hot, sticky gum that you get stuck on your foot and in a hot day in a parking lot. So you never really get rid of it. And we used to have a saying years ago, is that a limited partnership, which kind of what this is where the general partner has all the experience in the beginning and the limiteds have all the money. And in the end, the limiteds have all the experience and the generals have all the money. So unfortunately, the sizzle hasn't met the steak on a lot of the syndicated deals. You have to be very careful. So again, do your due diligence.
So well said. And I want to run down a few other points too. It's 100% real estate with the Delaware Statutory Trust, right? So it's just another form of a 1031 exchange. So for owners out there, we've closed Delaware Statutory Trust, we've closed 1031s, and of course Deferred Sales Trust. And so what you're doing is just trading, your real estate, and you're identifying with a qualified intermediary before your 45 days. either, 1, 2, or 3 positions with the Delaware, and then you're closing within 180 days. What I do like about them is they're pre-packaged. Typically, we've worked with some really big companies when it comes to this, and it's pretty seamless there. So you can kind of like pre-identify, if you will, and then kind of save your position. Not guaranteed, but that is a good spot. But it's the old depreciation schedule, something to mention too. So remember, in a 1031, your old depreciation schedule is traveling, and so if you fully depreciate it, you're moving over, and you're only getting more depreciation on the higher part of what you sold for. So that's not a positive for you. Versus the deferred sales trust, if you were to buy a deal on your own, you can get a brand new depreciation schedule. It's illiquid typically for 7 to 10 years. And so back to Michael's point, not only are you giving up complete control to this operator, which they're some really capable ones, the returns are around, I've seen around 5% cash flow, big fees, maybe upwards of 6%. You gotta be very careful with that. But you're illiquid, meaning like they have that property for 7 to 10 years, and they have all control about when they sell it. You can't just get your cash if you need it. You can't increase your payment if you wanted more cash flow. So a lot of our clients also think it's a highly appreciated marketplace, right? So values are way up. So the same reason you might not be doing a 1031 exchange is a lot of the same reasons why you wouldn't do a Delaware, because you're selling high and buying higher 180 days later. That being said, there are places for the Delaware Statutory Trust, and we still advise and help clients with that when it comes to looking at those, and that would be the financial advisor's role. But some of the reasons they've done it would be like a mortgage over basis, right? Where you have a property that has a very low basis. In fact, we're doing a deal right now in Minnesota. It's a $6.5 million sale, zero basis, but he has $4.5 million of debt. Okay, so he's stuck between a rock and a hard place. That mortgage over basis, that debt needs to be replaced, and the deferred sales trust cannot help with that. But what we can do is a partial deferred sales trust and a partial Delaware. So what he's planning on doing is selling, moving all the funds into a QI to start, and then replacing that $4.5 million of debt via a Delaware with a really high LTV deal. Typically around, it could be 16 to 20% down payment to replace that 4.6. So now that debt's out of his name, it's non-recourse, he has some of his cash there, then the remainder can go into the deferred sales trust, which is nice because now he has the liquidity, he has the diversification, and he has the chance to increase or decrease that cash flow. And he's in his 80s, and so he's really focused on retiring from all of it, right? And so he likes that. I would be remiss not to mention that the Delaware also maintains what's called the stepped up basis, right? The deferred sales trust does not. The deferred sales trust is an exit plan versus a 1031 or a Delaware, which is a continuity strategy, which is just continuing the deferral. That being said, you can pass the deferred sales trust inside of your living trust, and your kids can step into your position, but they wouldn't get the stepped up basis like they would for the Delaware or the 1031. But most of our clients don't want to have to die, right, Michael, to enjoy their wealth and retire from all of this. So and also too, they don't necessarily want their kids just to cash out of all their, call it millions of dollars without some kind of something holding them back, right? Where at least the deferred sales trust, it's incentivizing them to keep it invested. So I'll pause there. Any thoughts on anything I just said there, Michael?
Yeah, well, that was quite a bit. So the interesting thing about the step up in basis is it is a bit of a mixed bag on the step up in basis. If you're but most of the time it's a great thing to get the step up in basis for your kids. But I personally am not living for my children. I hope none of our clients are, but in the event it is kind of an added benefit for the heirs. But just to point it out, there is a presidential candidate who wants to remove not only the 1031, but also the step up in basis itself. Now, at a certain high net worth level, the step up in basis winds up being a curse. Actually, let me explain. Let's say you have a net worth that is substantially over the 22 million, which, by the way, will sunset in just about 3.5 years on the estate tax. At that point, you start paying 35%. Now, a lot of times with an installment sale, you can discount the value of an installment sale at death on what's called a 706 form because it's substantially illiquid and inaccessible. So because you can discount it doesn't mean that it will go up to full value. Now, when you step up in basis, you're actually showing your cards to the IRS and saying how much the property is actually worth. And you're trying to, at one level, you're trying to say it's worth a lot of money. On the other level, you don't want to say it's a lot of money. Also, the state of California, where we are, has proposed to increase taxes by 16.8% and then have a wealth tax at about 40 basis points. So now you got a lot of things going on. You just showed your cards. And while on one level, maybe you escape the capital gains taxes somewhere down the road. But if you don't plan on selling it, again, you explained a circumstance, which is a MOB, which is a forced the hand investment. You're never in a good position if you're forced to have to invest under the terms of the tax dog kind of wagging you on that. If you need to be in a position in life. I listened to Warren Buffett one time. He said, your ability to say no in life will make you wealthy. So the more choices that you have with things are going to make you and your family very, very wealthy. And given the fact with the deferred sales trust, it can, as we talked about, can tax engineer during your lifetime is far more important. Discounting the value at death is a slight benefit, but it may be in certain cases where we can, with our structure, may be able to get it out of the estate, or maybe use premium finance to offset what the obligation is, actually using the house money, which we'll go into another session. So there's other ways to deal with the taxes or a potential liability in the future. Life insurance is a great way to offset those costs. And really, what you're pointing out is the deferred sales trust is the Swiss Army knife of solutions on different things that I think that you'll find very, very favorable.
Well, so well said, Michael. And that being said, we're running down on time here. For our listeners who are interested, our next episode is actually going to be focused on exactly that, what Michael just said, making the deferred sales trust an investment rather than an expense. And it's one of the best kept secrets to the deferred sales trust. It's kind of like DST 2.0. And we're going to talk about premium finance, life insurance. We're going to talk about the net income tax advantage with the deferred sales trust by either delaying payments with the deferred sales trust and while you're still a high income earner, perhaps even moving out of state and establishing residency in a different place. And then the other one would be just the estate tax, how the deferred sales trust can really benefit you on the estate tax if you are above those limits. That being said, you can go to capitalgainstaxsolutions.com if you have a live deal that you're looking to sell, okay, and get your free deferred sales trust consultation. You can also download our free ebook, Sell Your Real Estate or Business Smarter and Other Highly Appreciated Assets in 9 steps. As well, you can connect with us if you're a business professional listening, going to experttaxsecrets.com to learn more. And with that, we encourage you to also join the estate planning team to be able to offer this to your clients if you're a business professional listening. Michael, any last words before we let you go?
Yeah, maybe we have a little teaser for the future, which is the Swiss Army knife of the many benefits of the deferred sales trust, which is, offsetting the cost through life insurance to do, as you were talking about earlier on the real estate, is that you're actually with the deferred sales trust. Imagine if you're able to recast purchase price and you could start depreciation all over again. And like we talked about, you could rinse, wash, repeat, sell that when you ran out of runway of depreciation and recast it again. Imagine that would also offset maybe cash flow that you had to shelter your income from it during both your lifetime. So I think the deferred sales trust can give you the best of both worlds of that step up in basis, depreciation, tax engineering, and terms that you have. And so with that teaser, we'll talk about it another time.
Exactly. Thank you, Michael, and thank everyone for listening. Again, we want to encourage you to share, rate, review. We really appreciate it. We're on a mission to help people escape feeling trapped by capital gains tax when they're selling their high-end primary home, public stock, private stock, investment real estate. It could be cryptocurrency. Anything that has capital gains tax, we are here to help, and we'd love the opportunity to be of service to you. And with that, have an awesome rest of your day. Go serve and bless others, and we'll talk again real soon. little bit delayed here. It's a YouTube, but it will stop here in a minute.